Joining me now is Michelle Schneider. She's the Chief Strategist at MarketGauge.com. Michelle, welcome back.
Nice to see you.
So what are you looking at most closely as we start the session?
Well, I'm certainly looking at the broad indices and particularly the small caps. I mean, it's hard to believe that we can say that it's really up to the small caps to save the market. We haven't said that in a very, very long time. And right now they're outperforming the SPY. And even though the momentum across the board has dropped in divergence to the price, if that can stay in the game, considering all the numbers that came out today with a higher PCE, slower GDP, labor being relatively in line with not too concerning, but certainly not exactly celebratory, that would be good for the market. That would give confidence that whatever the policies are, whatever the headlines are, it's helping the U.S. economy.
All right, and let's dive into that latest data. As you mentioned, we heard the GDP rate and PCE data earlier this morning. What stood out to you the most about those numbers, Michelle?
Well, I wasn't really particularly surprised to see a higher PCE. A lot of the heels on that falls in the health area. And of course, health costs have risen. And in terms of the GDP, I wasn't so surprised to see that either because it was so elevated on the last one. They're blaming the shutdown of the government for part of that. But essentially, my takeaway is that exactly what you don't want to see, which is the economy slowing and prices rising. And I think that's a trend that we have to keep an eye on to see if this was just sort of some kind of blip or whether this is the sustainable path, in which case that would be trouble for the markets, but possibly very, very bullish for some commodities.
All right, and Michelle, you'll be keeping a close eye on weekly jobless claims and the overall labor market. How has this been impacting the markets?
Well, I think it really doesn't impact the market as much as it could. What's more impacting is trying to figure out what the Fed is going to do about all of this. Are they going to pay attention to the PCE? Or are they going to pay attention to a labor market that a lot of people fear is going to get softer and softer? And those interest rates, I think, are going to be the most influential thing in the market right now. So especially, let's go back to our Russell 2000. That whole area of manufacturing and industrials in the U.S. count on lower borrowing costs, as does real estate and a bunch of other areas as well. But if we just focus on that, right now, what's so interesting is that we've seen optimism that yields will fall. The minutes showed obviously a lot of dissension, and that will continue, I think, to be the case for a while. But overall, if this path stays where we can get the yields a little bit lower, and particularly if we're looking at long bonds, if those can continue to rise through the TLT and get through this 90 level that they hit this week, then I think that's going to be very positive, again, for the small caps. And that, of course, will trickle to the beat up stocks that we've seen in growth, AI, and software.
And we're in the back half of earnings season. It's almost coming to a close. What are some themes you feel investors should be taking away from the results so far?
Well, obviously, we've seen the software stocks get hit, even with some really positive earnings. So I would be looking, if the market can hold here, and again, watch those small caps. I'm looking at some of those software stocks that have been beat up. I'm looking at Advanced Micro Devices, and I'm looking at cybersecurity through CrowdStrike. You know, we're still long Micron and a bunch of other software stocks that have done much better. So that's one area. You can't forget about that because growth in technology is not going away. Outside of that, Ashley, I still really like the vanity trade, I call it, which is the trickle effect from the diet drugs. We've seen stocks like Victoria's Secret do well. Elf is trying to base out. Ulta's been on a tear. It got over 700 and retreated, but you can see the momentum in that has been fantastic. Some of the smaller stocks are worth looking at right now, like iPar, which is a perfumery, Garmin, which is technology to help you measure how many steps you take, et cetera. So I think there's opportunity there. And I'm really looking still at hard assets, not so much gold and silver, although they took a nice bid today. But outside of the energy space, some of the grains are starting to look very interesting. The implication we'll worry about later, but now looking at wheat and soybeans looks like they've bottomed.
And how, Michelle, should investors be navigating the commodity space?
Well, I think if you're going to trade gold and silver, my number one tip is to watch the ratio between the two. Gold is trading or was trading yesterday at about 65 times the price of silver. If that drops below 60, I think that favors silver. You just have to trade with an understanding of volatility. I think you really have to watch the oil market here at $66. That's a pretty good breakout. If that holds, that could fly. Natural gas to me seems ridiculously cheap. I think there might be an opportunity there. And then outside of that, I'd be looking at not just the wheat and the soybeans, but I'd be looking at DBA, which is an ETF. That really is a composite of a lot of different agriculturals, softs, even some live cattle in there. That looks like it's getting ready possibly for a major breakout. So there's opportunity there, but you have to wonder what happens if those things really accelerate, energy and food. Not so good for inflation numbers going forward.
All right, thank you, Michelle Schneider, Chief Strategist at MarketGauge.com.
Thank you.